Welcome back, everybody. This week, the House and Senate are expected to take final votes on the financial reform bill, but is it really bankable reform? Michael Iannaccone of MDI Investments and Rebel Cole of DePaul University are both back with us. Welcome back, guys.
Thank you.
Let's start out with the Volcker Rule, and basically what the bill says, it prohibits commercial banks from speculating in trading of derivatives, and banks can invest up to 3% of their Tier 1 capital into private equity firms and hedge funds. Rebel, let me ask you, how effective is this really?
This was so effective that when it was passed, the bank stock prices went up by 3%. I think that says it all.
On Friday, that day when it did pass. Michael, what do you think about the Volcker Rule being in this bill?
I don't think it's much to do about nothing, actually. And they're saying that the banks can invest in a vehicle, the hedge funds, that they're basically making them register as investment advisors. And I think there'll be less hedge funds because of that. So. Yeah. They're giving them the right to invest in something that's no longer going to exist. Okay, speaking of another idea that was really watered down as well, we're talking about the over-the-counter swaps markets. The swaps are going to have to be cleared on exchanges, and the bill says it's going to prohibit federal bailouts of swaps entities. And commercial banks are only going to be able to engage in bona fide hedging and traditional bank activities. That is what is permitted in trading swaps. Now, how watered down is that, Rebel?
Well, they've defined that to include such things as interest rate swaps, which account for the vast majority of derivatives. So really all they've really excluded is some credit default swaps. So it's been virtually totally gutted so that there's no teeth.
Well, I disagree there. That I think this is one of the cases where they took this 2,000-odd-so page thing and they said, well, we're not coming up with the definitive rules. We're going to let the regulators come up with the definitive rules. And when the regulators go in and see a bank that's over $50 billion, they're going to decide what proprietary trading is and what isn't. There's no black line test that's going to be in the bill.
But the banks are going to say that everything falls under
Well, they're not going to be able to make that argument that everything.
Hedge. But don't you think they are, Rebel?
I think they're going to push that way. The other thing is that the requirement that these derivatives be put on exchanges or cleared is subject to interpretation by the regulators and the exchanges. So we didn't really even know what's going to be covered here. There are so many loopholes through here, so you can drive a truck through them. Okay,
so if the regulators are making the rules and if they're writing the rules, how much of an influence is the banking lobby going to be on these regulators, Rebel?
Virtually zero. They've done their damage. There's 2,319 pages in this bill, and over half of it is loopholes.
Michael,
well, I agree with him there that regulators cannot be influenced by lobbies because they have guaranteed income. They have a guaranteed job. There's nothing to bribe them with or to frighten them. I think it's better that the regulators get the right to make the rules as opposed to Barney Frank, who, you know, where is the accountability for the Congress people who put all this legislation in place that caused the problem in the first place?
Okay, we're going to talk about that on another day, but let's get to this other big idea, the liquidation authority, setting up a mechanism to wind down a failing firm, and to pay for any costs, the government will charge assessments on large financial firms with assets greater than $50 billion. But despite this rule, can the government still go in and save a failing financial firm, Rebel?
The first rule is that in a financial crisis, there are no rules. So they will do exactly what they want. If Citibank's about to go down the tubes, you can be pretty sure they're not going to close Citibank.
Yeah, Michael?
And it's always cheaper to save an institution than to let it fail and to clean up the mess afterwards. So yes, when we're in a financial crisis, the regulators will do what they have to do in order to prevent systemic risk in the industry, in order to save themselves money, in order to keep people at work.
But the systemic risk is still with us today.
It'll always be with us because the U.S. economy is closely tied together and the global economy is tied together. You're not going to be able to legislate out systemic risk. Everybody would have to be in separate silos on very distant farms for all of that to happen.
The banks are so interconnected, Rebel. If one firm goes down, they're all going to suffer.
This is the key. It's no longer too big to fail. It's too interconnected to fail, as is Lehman Brothers and AIG. The big losses at AIG, for example, weren't at AIG. They were at the counterparties. We bailed out the counterparties. We didn't bail out AIG. The same will happen with the next systemic crisis, the next big institution. It's not going to be one institution unless, of course, it's Fannie and Freddie. It's going to be a bunch of institutions.
Could Congress have addressed the issue of too interconnected to fail? Could they have addressed that in this legislation if they wanted to?
It's difficult. The only way to deal with too big to fail and to an extent too interconnected to fail is if you're too big to exist. They need to put a hard size cap on the size of these institutions. And I would recommend something small, like $100 billion.
They wouldn't have been able to do that. And if you're asking if it took them, whatever it was, 2,300 pages with this, which we're considering watered down legislation, would have taken them 10,000 pages to get through that, and then it's too big to pass is your
okay, real quick,
terminology.
Michael, how is this new legislation going to affect earnings power for banks?
Well, any new legislation is always going to put a burden upon banks in order to increase their compliance. They're also going to have stricter underwriting standards. Interest rates will probably go up to the consumer, and the investors' returns will initially fall.
Okay, lots more to talk about in this very big legislation, but thanks so much, Rebel Cole of DePaul University and Michael Iannacone of MDI Investments.